Welcome to today's Explainer. We are jumping right into what I can only describe as a perfect storm. We're going to unpack how a massive, physical shipping blockade halfway across the world and a sudden, truly shocking shift in domestic interest rates are converging to squeeze the global economy in ways we just haven't seen in decades. To make sense of all this, we're going to cover 4 key areas today. First, the Strait of Hormuz crisis. Second, the drain on global energy supplies. Third, the Fed's new direction. And finally, reading the yield curve. Let's get right into it. Section 1. The Strait of Hormuz crisis. Okay, so when this whole conflict kicked off back on February 28th, I think a lot of people expected a pretty quick resolution, but tracking it over time reveals a really stark escalation. We started with those initial strikes, right? But by week 11, the U.S. had to begin active blockade enforcement to stop commercial ships from heading into Iranian ports. And then by week 13, the entire risk calculation changed with confirmed sightings of naval contact mines floating in Omani territorial waters. That is a massive escalation. And to enforce this blockade, the U.S. has taken some seriously unprecedented action. They have already redirected 116 commercial vessels. Let that sink in. 116 ships. And they aren't messing around. This enforcement has actually included using Hellfire missiles to completely disable non-compliant ships, like a commercial vessel known as the Leon Star. They put an absolute hard stop to its transit. The ripple effects here are just monumental. The leadership at the Port of Los Angeles has explicitly warned us. Global shipping will simply not normalize until this specific region stabilizes. The sheer chaos of this is forcing ships to take massive, extended detours all the way around South Africa, which then puts severe bottleneck pressures on the Panama Canal. We're even seeing the rise of dark ships. These are vessels literally spoofing their tracking systems to hide their locations, making it look like they're sailing through the mountains of the UAE. And guess what? All of this translates directly to surging fuel and insurance costs being passed right down the supply chain to you. Which brings us to Section 2, draining global energy supplies. The immediate consequence of all this physical restriction is a rapid, heavy drain on the world's resources. And the numbers from the International Energy Agency are frankly staggering. Since the conflict started, this closure has already wiped 12.8 million barrels per day of oil supply right off the board. To put that into perspective, we have a terrifying gap forming in the global market right now. Global demand is sitting up at 104 million barrels per day, but because of this Hormuz chokehold, total global supply has basically fallen off a cliff down to just 95.1 million barrels per day. When demand outstrips supply to this degree, the entire market strains. But here's the thing. It isn't just oil. There is a huge, sort of forgotten crisis brewing here. Vital fertilizers, specifically compounds like urea and DAP, are completely stuck behind this blockade. And without those fertilizers moving out of the Persian Gulf, we are literally setting the stage for a catastrophic agricultural crisis. Farmers in developing nations across Africa are bracing for severe food shortages. It's a huge deal. All right, shifting gears to Section 3, the Fed's new direction. So we've got this massive physical supply shock underway globally, right? And it is crashing headfirst into a major monetary shift happening right now at the U.S. Federal Reserve. With Jerome Powell out, the market totally expected the new chairman, Kevin Warsh, to be dovish, to lower rates. Well, scratch that. He caught the entire financial system completely offsides. He came out with this strictly hawkish, Paul Volcker-style stance. For him, inflation is the absolute unbending priority. And to execute this new, super aggressive vision, Chairman Warsh announced he's layering 5 entirely new task forces over the existing Federal Reserve structure. We're talking dedicated task forces for communication, the balance sheet, data sources, productivity and jobs, and of course, inflation. Now, financial analysts were super quick to point out the irony here. The Fed is already comprised of over 900 PhDs. 900. So a lot of observers are suggesting that adding more task forces over an institution with that much academic brainpower is arguably less about actual functional policy and more of a psychological operation. It's a way to project an image of control to manipulate market behavior. Let's move to Section 4, reading the yield curve. So, how are investors actually reacting to plummeting supplies on one hand and a surprisingly hawkish Fed on the other? Well, we look to the yield curve. Looking at the spread between the 2-year and 10-year treasuries really cuts through all the political rhetoric. It acts as the ultimate truth teller, showing us exactly where the smart money believes the economy is heading. So the million-dollar question is, What is the market actually telling us? Because immediately following Warsh's hawkish press conference, the 2-year Treasury yield violently spiked by 10 to 15 basis points. But the 10-year yield, it barely moved at all. That creates a really fascinating discrepancy that we need to decode.
What that discrepancy means is a flattening yield curve. Essentially, the bond market is calling the Fed's bluff. The market is signaling that a weakening global economy, one that is getting heavily battered by the exact supply chain shocks and energy drains we just talked about, will inevitably force the Fed to abandon its tough stance. The market believes that, despite the hawkish talk, lower rates are simply inevitable.
Which brings us to a very simple equation floating around financial circles right now: 0 plus 0 equals 0. Ultimately, if the Fed's predictive accuracy regarding inflation in the economy in the past has essentially been 0, adding a new layer of psychological task forces to that exact same system still equals 0 predictable success for the future. The market just isn't buying it. The crucial takeaway from this explainer is that you are standing right at the intersection of a massive physical supply crunch in the Middle East and extreme monetary uncertainty back at home. The perfect storm is here, which leaves us all with one final vital question. Just how long can your wallet weather this storm before something breaks? Keep your eyes on the data, and thanks for joining me today.